The Swiss National Bank raised its policy rate by 25 basis points earlier on today, in line with what the markets were expecting, although there was some suspicion that they may hike by 50 basis points based on what Thomas Jordan, the SNB chair, has recently said. He's recently alluded to the fact that he believes that the neutral rate is somewhere around 2%. Now, of course, this is still much lower than what we're seeing from other central banks, but then so is inflation. Inflation recently fell to 2.2%, but the SNB's target is below 2%, which means there is still a little bit further to go. But the issue that the SNB has is that they believe that it's going to remain around those levels over the course of the next 2 years, meaning that on the policy horizon, they still believe it's going to be above target. And they alluded to the fact that there is still likely more to do going forward, and that's why another 25 basis point rate hike is likely when they next meet in September. Their forecast for inflation this year is to average 2.2%, the same next year based on stable interest rates, and then 2.1% in 2025. So clearly the S&B is of the view that there is still a little bit more work to be done. The other thing that they referenced is the FX interventions in the market, still keeping the options open to continuing to buy the Swiss franc in the markets to stop any easing in the value of the Swiss franc. This is a core part of their tools of ultimately in terms of keeping inflation lower, the stronger franc. Of course, in the past, it's been a very different story. We'll remember, obviously, going up to 2015, the intentions and the desires with the currency pegs was to keep the Swiss franc weak because we were seeing not necessarily currency wars amongst other nations, but we were seeing weakness because of excessive QE programs that were being announced around the world, and therefore the Swiss franc was remaining very strong. Now we're seeing a different situation. The Swiss National Bank sees value in a stronger franc, and it is determined to do whatever is necessary in order to ensure that it doesn't weaken and make its policy path that much more difficult. And that really takes us now to the Swiss franc itself. You can see on the chart here, we've got the US dollar Swiss franc pair. And as you can see on that chart, we have been trending lower. Now, that has been the case for quite some time. It's been quite a steady trend to the downside. But what's interesting really since the middle of April is we've moved into a range roughly around 88.50 through to 91. And that's where we've held steady during that period of time. Now, what is interesting around this level is that during that time, we have tested the upper range of that descending channel. That's the orange descending channel lines that you can see. We've come close to there for a second time. Last time we came there was around the March period. And we've trended low from there. But that also coincided with that 91 level. 91 is previously a significant area of support and has now become a significant area of resistance during the continuation of that downtrend. It also coincides with the upper end of the 55-89 day simple moving average band. Now, looking back in this scenario, the price action hasn't overly respected that. So individually, then I would suggest there is a bit of a weak correlation between the two. But the fact that it coincides with those other areas of resistance does potentially reinforce that slightly, that we could potentially be seeing this be a key zone of resistance if we do see a rotation to the upside. Ultimately, a break in 91, I do believe, would be quite significant if we do see that, with the next major test then coming around that 200-233 day simple moving average band around 93.50, 94. And again, that would be far much more significant area of resistance potentially, because you can see that that has actually been respected previously as an area of support and resistance. We know markets do pay close attention to the 200-day simple moving average in particular, but it would also coincide as well with those previous highs from early March, but then support levels going back to the latter part of last year. However, there's no guarantee that we are going to see a break of that 91. And the other area that I think we've got to pay close attention to is that range low. That's around 88.50. You can see the two areas marked here from the recent lows. It's 88.20 and 88.60. So there or thereabouts is where the range lows do kick in. What's going to be interesting is how the momentum indicators look around those range lows should we continue to see a move to the downside. The recent trend from the last couple of weeks has been lower. We then saw some consolidation over 3 days. That was late last week going into early this week. We saw 3 very small positive days before we saw the sell-off continue yesterday. So that would suggest that there is still some downside momentum. And a look at the momentum indicators also supports that, alongside the lower lows that we've seen over the past few weeks in the dollar Swissy pair. We've seen lower lows on the stochastic, and we've also seen lower lows on the MACD histogram and the MACD moving average. So that suggests there is still some momentum going into that potential support zone that has been such a key area of support in April and early May. It'll be interesting to see if on the 4-hour chart, when we do get closer to that 88.50 level, if the momentum indicators do continue to point lower and support the descending trend, or if we start to see divergences occur. Divergences being when we see prices trending lower with lower highs and lower lows, but we see the momentum indicators like the stochastic and the MACD, but you could also say so with the RSI as well, making higher lows, because that's seen as not confirming the price action and potentially signaling a weakness in the recent trend. But either way, a breakout in either direction I do think would be significant and give us a significant indication as to whether the market remains bearish on this currency pair, or if with both central banks nearing the end of their tightening cycles, whether we are going to see a more bullish shift, a more hawkish shift potentially from the central banks, which could potentially signal a shift in either direction, either above 91 or below that 88.50 level.